Introducing Threads of History, a podcast that aims to go back in time to connect an event or instance to its origin through several threads of continuity across time, space, culture, and historic moments. Welcome to the podcast. My name is Mike Shellhammer. I am here to tell you about redlining and its impact on socioeconomic outcomes for minority groups in the United States. Here's the deal. There's no getting around the ingrained racism in the United States. I grew up hearing racist jokes told by friends and family in the 90s in rural Pennsylvania. The joke about Kentucky existing between Pittsburgh and Philadelphia could be my Pennsylvania town's motto. Though we are more urban than most areas, and our town's racial history could be the subject of another episode, the fact that racism was alive and well above the Mason-Dixon line might come as a shock to some people, or simply not fit into the narrative people tell themselves to feel good. I know of at least one local house with a Confederate flag prominently displayed, and at least one story of the KKK burning a cross on a local family's front lawn. As isolated as these facts may be, the idea that racism continues to be a current issue is not a secret, and to argue it's gone or solved because of the Civil Rights Act or any number of laws is naive at best and dangerous at worst. Given our country's history, the lower wealth and socioeconomic outcomes for minority families should not be surprising. There are some out there that would like you to forget how we got here and ignore hundreds of years of oppression, both overt and covert, that continue to influence these communities today. Growing up in a briefly quote-unquote colorblind society, I did not think about how racist activities in the past could have such a profound impact on people today. I imagine you might think the same. This led to the establishment of redlining. What is redlining? The term redlining was coined by sociologist John McKnight in the 1960s and derives from how the federal government and lenders would literally draw a red line on a map around the neighborhoods they would not invest in based on demographics alone. In the 1930s, the federal government began redlining real estate, marking risky neighborhoods for federal mortgage loans on the basis of race. Redlining is the discriminatory pattern of disinvestment and obstructive lending practices that acted as an impediment to home ownership amongst African Americans and other people of color. Banks used the concept to deny loans to homeowners and would-be homeowners who lived in these neighborhoods. This in turn resulted in neighborhood economic decline and the withholding of services or their provision at an exceptionally high cost. The origin of the term redlining stems from the policies developed by the Homeowners Loan Corporation, HOLC, created in 1933 by the Franklin Roosevelt administration to reduce home foreclosures during the Depression and then institutionalize them by the 1937 U.S. Housing Act, which established the Federal Housing Association, or the FHA. Federal housing agencies, including the HOLC and the FHA, determined whether areas were deemed unfit for investment by banks, insurance companies, savings and loan associations, and other financial services companies. The areas were physically demarcated with red shading on the map, and that's where we get the name redlining. This created every single quote-unquote ghetto or bad neighborhood you can ever claimed to have been in. And these policies weren't just felt in housing. Lending for businesses and other institutions could be withheld or prohibitively expensive in these areas of cities. As a result of these policies, shopping and other commercial activities might be far away from these neighborhoods. You would get food deserts, an area without fresh food within walking distance, and white homeowners even today are 20% more likely to own their homes. If you've ever rented an apartment, like I did for 6 years, or you teach economics for 7 years, like I do now, you know that any investment that does not gain you equity is a bad idea. Renting does not gain any equity for a person. You cannot use it as collateral for extending credit. You cannot sell it and gain profit from appreciating assets. Rent is a liability. A mortgage is an asset in many cases. Redlining has resulted in a racial wealth gap between white Americans and other racial groups in America. Redlining has led to lower life expectancy, higher instances for chronic diseases, and lower overall health outcomes for groups living in these old red-lined neighborhoods. Educational attainment has lagged for minority-dominated schools versus white-dominated schools, which are often demarcated by the old redlining maps. Redlining has resulted in higher property taxes, proportionally for black and minority families than for white families. Redlining has given us lower socioeconomic mobility for black and minority individuals, especially when compared to poor white individuals. A racial wealth gap continues to hold down minority families in an era when some white people think that racism is gone because America had a black president for 8 years. These threads of history matter because they give us a line going back decades to explain the contemporary inequality between white and black and minority families. It is a legacy that is passed down generation to generation through unequal monetary inheritances, which make up a great deal of current wealth. In 2020, Americans are projected to inherit about $765 billion in gifts and bequests. Inheritances account for roughly 4% of annual household income, much of which goes untaxed by the U.S. government. Although the Community Reinvestment Act was passed in 1977 to help prevent redlining, critics say discrimination continues to occur. For example, redlining has been used to describe discriminatory practices by retailers, both brick and mortar and online. Reverse redlining is the practice of targeting neighborhoods, mostly non-white, for higher prices or lending on unfair terms, such as predatory lending of subprime mortgages. Just how large and persistent are these racial wealth gaps? Median net worth for white neighborhoods has far exceeded that of black households through recessions and booms over the last 30 years. While movements in white wealth are easier to see due to the larger scale, during the most recent economic downturn, median net worth declined by more for black families, which is a 44.3% decline from 2007 to 2013, than for white families, which was a 26.1% decline over the same period. In fact, the ratio of white family wealth to black family wealth is higher today than it was at the start of the 21st century. The typical young adult, 18 to 34 years old, of either race has little wealth, but the gap rises quickly with age, and for 65 to 74-year-olds accumulates to $302,000 in median white wealth, but only $46,890 in median black wealth. Guess which generation might have tried to buy a decent home only to be turned away by the bank using a red-lined map in the 1940s and 1950s? The result of this redlining in real estate could still be felt decades later. In 1996, homes in redlined neighborhoods were worth less than half that of the homes in what was the government had deemed the best for mortgage lending, and that disparity has only grown greater in the last 2 decades. White families receive much larger inheritances on average than black families. Economists Derek Hamilton and Sandy Darity conclude that inheritances and other intergenerational transfers, quote, account for more than the racial wealth gap than any other demographic and socioeconomic indicators, unquote. A homeowner in an area once redlined by the government has gained 52% less in personal wealth generated by property value increases over the past 40 years than a homeowner in an area with a better historical rating. All of this matters because wealth confers benefits that go beyond those that come with family income. Wealth is a safety net that keeps a life from being derailed by temporary setbacks and the loss of income. This safety net allows people to take career risks, knowing that they have a buffer when success is not immediately achieved. Family wealth allows people, especially young adults who have recently entered the workforce, to access housing in safe neighborhoods with good schools, thereby enhancing the prospects for their own children. Wealth affords people opportunities to be entrepreneurs and inventors, and the income from wealth is taxed at much lower rates than income from work, which means the wealth begets more wealth. The courts have determined that redlining is illegal when lending institutions use race as a basis for excluding neighborhoods from access to loans. In addition, the Fair Housing Act, which is part of the Civil Rights Act of 1968, prohibits discrimination in lending to individuals in neighborhoods based on their racial composition. However, the law does not prohibit excluding neighborhoods or regions on the basis of geological factors, such as fault lines or flood zones. And you can imagine those zones being populated by poor housing. The destructive legacy of redlining has been more than economic. A new 2020 study by researchers at the National Community Reinvestment Coalition, the University of Wisconsin-Milwaukee, and the University of Richmond finds that, quote, the history of redlining, segregation, and disinvestment not only reduced minority wealth, it impacted health and longevity, resulting in a legacy of chronic disease and premature death in many high minority neighborhoods. On average, life expectancy is lower by 3.6 years in redlined communities when compared to the communities that existed at the same time but were high graded by the HOLC. Unquote. Keeping black families out of certain neighborhoods, then basing the funding for neighborhood schools on local property wealth, like many states do, results in poorer school districts having a higher than average minority population. Lower educational opportunities leads to lower economic opportunities, which leads to higher crime rates. There have been efforts to desegregate various public school systems across the country. As you might know, Brown versus the Board of Education in 1955, a Supreme Court decision that outlawed segregation in schools, has had problematic rollout. There are public schools across our country that have a vested interest in making sure that poor and minority students stay out of their halls and out of their classrooms. And that's just sad. As an educator, I feel like it is my duty to teach these students, to bring these students into the modern day with skills that they will need for the 21st century, for their workforce, for living a good, fulfilling life. Some schools don't care about every student, they just care about their own student. And they want to spend as much money as possible on that one student, potentially just lining their own pockets. That is part of the reason why public schools, especially, are very top heavy, is what you would call it. Administrators given titles when they are just a glorified football coach or basketball coach or baseball coach. Nepotism is rampant in public schools. So any poor neighborhoods and poor neighborhood schools are left out of these more affluent schools because the school district lines have been drawn in such a way that excludes them. It is no surprise that whenever you have neighborhood schools and school districts divided along racial lines, that you have poor and minority students become concentrated in schools that lack resources. The effects of redlining are compounding. Schools in minority neighborhoods score worse, waste more funds, and pay more per student than those in more affluent neighborhoods. School districts have a vested interest in pricing undesirable people out of their neighborhoods. In these areas, wealth begets wealth, and poverty often leads to more poverty. It is not something ingrained in these people or their neighborhood school that makes them fail or makes them not do as well as the other affluent schools. It is the denial of opportunities available at those better equipped schools. This is anecdotal, but many students who come from the poorer school districts around my private school are suddenly better students in the school in which I teach. This is a difference not in their home life or even in their friend group, but the school environment. And we do so by spending way less per student than any public school. Schools in minority dominated neighborhoods, largely due to historic redlining, suffer from higher than average property taxes and lower than average school quality ratings. Poverty is rampant in these neighborhoods. Home ownership leads to higher socioeconomic outcomes, and the only thing holding back many minority families for decades was the Homeowners Loan Corporation and the FHA. It is shown today that economic mobility, the ability to reach beyond your current household income, is achievable by 43% of families in the most desirable areas, according to the old HOLC maps, while only being achievable by 31% of those in the redlined areas. Redlining also affects the ability to get fresh food and a decent job. Corporations are refused loans when they desire to locate in former redlined neighborhoods. A lack of fresh food, so-called food deserts, are formed when neighborhood markets are not allowed to locate in a bad neighborhood due to that neighborhood's historically high poverty rates and low home ownership, and that would all have been outlined in the redlined map by the HOLC. They all trace their origins back to redlining and discriminatory lending practices perpetuated by the federal government. Luckily, redlining does not exist in law now. It was eliminated partly by anti-discrimination laws like the Civil Rights Act of 1964, and then finally destroyed by the Fair Housing Act of 1968. Fair practices in housing are so universally important in socioeconomic outcomes that Congress, of all groups, had to pass a law to make sure racists didn't ruin it forever. This thread of history started with the 1917 case of Buchanan versus Warley, a decision that would mean more housing equality, but led to redlining, which would mean unequal access to financial resources to borrow for home ownership. That then resulted in the racial wealth gap, lower health outcomes, lower educational quality, and higher poverty for black and minority families. This is the systemic racism within our country that is so ingrained that we have a hard time seeing it today. But with some help, we can see this thread of history back to its origin and hope to remedy its worst outcomes. This is systemic racism that has incredibly stifled growth in poverty-stricken areas and allows the United States to say that we are not a racist country, while allowing racist policies to remain impactful today. This is how racist policies from almost 100 years ago reveal systemic racism, and that racism might not be practiced by most Americans today. It remains in place in surprising and covert ways. Even the people being discriminated against might not recognize the racism or the xenophobia being practiced within that system. That is why, through education, through things like this podcast, we can understand the connections between these actions and better understand the world around us. Thank you for listening to Episode 1, Redlining. This has been Threads of History. I am Mike Shellhammer. Thank you for listening. Find more Threads of History on Anchor and Spotify.